From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the jobs report gives the Fed the green light. Treasury yields taking out 2021 highs. Looking ahead to another big inflation print. We begin with the big issue, the Fed gearing up to hike.
The market's looking past the disappointment on the headline.
We're inching very close to full employment.
A 3 handle on the unemployment.
3.9% on the unemployment rate.
The Fed's dual mandate, right, is full employment and stable inflation.
Look at the data.
You could check that employment box. Right?
We are exiting very abnormal times.
It's all about inflation.
The Fed cannot escape the inflation issue.
They have a significant inflation problem on their hands.
That should, all else equal, means that the Fed should normalize its monetary policy in response.
There's nothing in the report that will change what the Fed signaled earlier.
This Fed needs to get to neutral.
Unfortunately, the Fed is having to hurry up.
We have got a fantastic lineup to close out the week. Joining us now is SocGen Subadra Rajappa, Morgan Stanley's Jim Caron and Troy Gayeski of SF Investments. Subadra, let's start with you. Your reaction to that labour market report from earlier this morning.
I think if you look at it from a holistic perspective, it was a pretty good report following a very strong ADP print. The household survey is very strong. Revisions for last month were also on the heading in the positive direction. Really, the headline miss is not that big of a deal because you're looking at an unemployment rate of around 3.9%. So the economy is at, if not close to, full employment. So to me, this is a very strong report. This is exactly what the Fed needed, or needs, I should say, to be able to raise policy as early as the March meeting.
Troy Gayeski, your take.
Yeah, I mean, it just confirms everything we've discussed the past 3 months, John, about how the Fed has been behind the curve. And, the reality of how perilous the state of fixed income investing is now, just given how much durations in various indices, how little of a rate rise it takes to, destroy a significant part of your income stream. And, the difference now, right, between 6 months ago or a year ago is that you also have eye-popping inflation numbers eating away at your principal every day, week, and month. So, there's nothing in this report to suggest that the Fed isn't going to attempt to catch up from where they have been, which has been behind the curve.
It's tough right now in fixed income. Jim Caron, just talking of the differences, speaking of the differences in the labour market, the relationship between unemployment and wages in this labour market is very different to what we saw for much of the first cycle, the last cycle. And Jim, I just wonder if you can comment on that.
Yeah, exactly. Look, this really gets to the heart of the matter. Effectively, what we're talking about here is the Phillips curve. So it's really the measure between the unemployment rate or the strength in the labor market and wages. And what we're seeing here, to me, what the key takeaway from this number is that wages are rising very, very quickly. The unemployment rate is falling. And this isn't the first time we've seen this. We've now seen this now for a couple of months in a row. So even though the labor market has been getting stronger, albeit a little bit slowly, it's now getting to a point where it's gaining traction and you're starting to get higher wage inflation. This is the Phillips curve. And what we have to understand with the Phillips curve is that this is the cornerstone piece of economic metric that is in the minds of every Fed official, that when they start to see a stronger labor market, higher wages, that means you can pass through higher costs, you get a higher inflation risk. So what we're seeing around the street today is that many people are raising their Fed funds forecasts, and in terms, not just in terms of magnitude, but also in terms of timing. Many people are bringing forward the first rate hike to March. So there's nothing in this labor report that is dovish for the Fed. In fact, it's the opposite. I would argue that it emboldens them to be a bit more hawkish at this point. And even we have to start to think about the balance sheet as well.
I think we're already there in many ways. Subadra mentioned the month of March. I heard from Matt Lazzetti of Deutsche Bank just moments ago. He said, we expect liftoff in March, 4 hikes in 22, QT to start this summer. We heard from President Daly a little bit earlier on this morning. She had to say the following: I would prefer to adjust the policy rate gradually and move into balance sheet reductions earlier than we did in the last cycle. I'd prefer not to do it simultaneously. You could imagine adjusting the balance sheet after 1 or 2 hikes. So let's build on what Jim Caron mentioned, Subadra. Just a sequencing here, not just the timing of liftoff. You mentioned the month of March, but the sequencing you expect after that.
Yeah, no, I think the Fed is on track to raise rates at the March meeting. And very soon after, perhaps as early as June, they can think about letting the balance sheet run off ever so gradually. But this time around, what I see is there's just a lot more. There's a lot more complexity involved in communicating the balance sheet runoffs, because unlike last time when they did balance sheet runoffs, the balance sheet was around $4 trillion. They started at 6 billion caps and then kind of worked their way through. This time around, they have I should say 4 trillion. This time around, they have 8 trillion plus in their balance sheet. So the communication is going to be a lot more challenging. So I think that they start balance sheet runoff. They could start balance sheet runoff as early as the June meeting. I don't see them, starting any earlier than that.
We've seen this movie a few times before, Troy. I wonder if the ending of this one is any different. Typically, when a market starts to think about a more aggressive Fed, the less chance it is that you actually get one, because they have to back away because financial conditions tighten too much. From a market's perspective, from an investor's perspective right now, Troy, what are the chances that they can actually engineer the kind of tightening that people are talking about?
Well, I think if you look at this cycle, John, it's a little bit different than the last one in that, because you already have eye-popping inflation numbers, and that's really become political problem number one for the Biden administration, not to mention the problem for the Fed in terms of their dual mandate. The so-called Bernanke/Yellen/Powell put is a little bit further out of the money. So, the Fed does want tighter financial conditions. They're more than likely going to get them. So that probably means is, equities end up with 2 to 3 turns of multiple compression this year. To your point, if balance sheet runoff leads to even more compression, the way we think about that is it may be somewhere in the 20 to 30 down range for equities. And the ultimate trigger for them to reverse that would be very similar to what it was in December of 18, which is when the high yield bond market froze up. So, whether they can actually pull this off or not, time will certainly tell. But it's going to be a choppy process. And it's one of those unique periods where both vanilla fixed income and equity risk both look very unappealing right now.
Well, let's talk about this a little bit more. We heard from BlackRock's Rick Reeder on where neutral is right now. I think this is the conversation we've got to get to away from balance sheet reduction, where neutral is on the policy rate. Take a listen to this.
Listen, I think this Fed needs to get to neutral. We're still putting liquidity in the system. So what happens now? I think the Fed needs to get to neutral. So now we're rushing a bit to get to neutral. Listen, the credit markets are in good shape, and we're not going to see any defaults of any significant magnitude this year. The economy's still operating at a good level. I still think you're going to see mid to high 4s in GDP this year. But then you got a Fed that's going to try and break this a little bit. And like I say, it's a bit awkward today in terms of how do you do that when inflation is accelerating.
Jim, when I heard Rick Reeder say that we need to get back to neutral, I think all of us thought, well, OK, where is neutral? Jim, have you got any thoughts on that? You talked about an earlier move from the Fed, possibly more hikes this year than previously anticipated. Have you got any thoughts on where neutral actually is?
Well, see, now here's the thing, right? So when we think about neutral, we think about a neutral policy rate, but we also now have to start thinking, and this is what's new in the markets, is we also have to think about what the neutral balance sheet is as well. So yes, the neutral policy rate is when the real Fed funds rate gets to 0. That's what's estimated by the markets, and we can figure out that that's probably close to the terminal Fed funds rate at 2.5%. Okay, that's fine and done. Yesterday's news. Here's today's news. Today's news is that the problem for the Fed is that they can't control the back end. They can control the front end, but the way that they control the back end is by moving the balance sheet, or is by shrinking the balance sheet. So let's run this in reverse. If the Fed is to hike interest rates, say, up to 2 to 2.5%, where will the 10-year Treasury be? Many analysts say that the 10-year Treasury can't really get much above 2%. So does that mean that we have a flat or inverted yield curve in a year or two? Is that a good outcome? Probably not. So I think the Fed really now starts to have to think about where the balance sheet neutral level is. They have to start thinking about the runoff and the shrinking of the balance sheet. So quantitative tightening, it probably doesn't start until later this year, but that's how they get the back end rate up, because they can't control it. That's the problem. We're watching the 2-year yield march higher, and eventually the curve is going to start to flatten. And what happens there is that if the economic conditions are good, then the Fed is not able to engineer a tightening of financial conditions, which is what they're trying to do if back-end yields stay low. So they got to get those back-end yields a little bit higher, and the only way that they can really do that is by engineering the balance sheet smaller, so some form of quantitative tightening. That's what's unknown, that's the risk, and that's why bond yields are going up, and that's a lot of uncertainty because nobody knows where the neutral balance sheet rate is.
Jim, there's
been no academic rigor on it.
A ton of uncertainty. to work through. And I think what you just said there is really, really interesting. So help me out just a little bit more. Clarify this. Are you saying that they need to use balance sheet in place of interest rate hikes, or use the balance sheet to allow them to deliver more hikes?
I'm actually saying a little bit of both. I'm saying that basically delivering more rate hikes isn't going to tighten financial conditions as much. What they have to do is they have to use the balance sheet and lean on the balance sheet a bit more. So if you were to ask me, would I rather see the Fed hike interest rates less and shrink the balance sheet more? I'd say yes. So I would rather see the balance sheet reduction come in place of some of the rate hikes, because just jacking up front end rates, all that's going to do is flatten the yield curve, given how much quantitative easing there's been, how big the balance sheet is currently right now, and how much money there is in the system, and where global yields are. Bond yields, long-term bond yields, are going to struggle to move higher, which means every single time the Fed hikes rates, they're just going to be flattening the yield curve, which is not the desired outcome effectively. So I'd rather see them start to use the balance sheet a little bit more.
Subadra, I want to give you the final word here, because you came out with your call for 225 when we were sub 150 on 10-year yields. Right now, on a 10-year at 176. Just give me your thoughts, with your forecast in mind, off the back of everything Jim's just said.
I completely agree with what Jim said. I mean, we've been writing about the balance sheet and the need for the balance sheet unwind, from, I would say, as late as late October, because, the yield curve right now, the 2-10s where it's at right now, is where the curve was when 4 or 5 rate hikes were delivered in the previous cycle. So the curve is extraordinarily flat, and the Fed hasn't even delivered 1 rate hike yet. So it definitely makes sense that they use a combination of rate hikes and balance sheet unwind at the same time to try to steepen out the curve as they're raising rates. So in that sort of context, and given how big the balance sheet size is, we think that an underappreciated risk is the balance sheet runoffs and what that could do to the long end of the yield curve, because we've seen a tremendous amount of term premium compression, and that term premium is going to get rebuilt into the back end of the curve. So I could easily see 10 years get to, say, 2%, and then 2.25% perhaps by the end of the year and even beyond, if the Fed is very keen on running off its balance sheet.
Fascinating stuff. Subadra Rajappa sticking with us alongside Troy Gayeski and Jim Caron. Coming up on the programme, up next, the auction block. The primary market pausing for payrolls following a frenetic pace to kick off the new year. That conversation up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe, with the primary market starting the new year at a slower pace. Sovereign debt sales from Italy and others helping push weekly volume towards 44 billion euros. US blue chip companies leading the charge in high-grade debt markets, blasting through estimates with 31 deals in the week's first 3 days. And finally, Royal Caribbean kicking off the year's junk bond issuance, increasing its offering amid solid demand, with weekly sales approaching $6 billion. I will never understand the cruise thing. That's a conversation for another time. Subadra Rajappa, Jim Caron and Troy Gayeski have thoughts on that too, but you don't want those thoughts right now. Subadra, I want to come to you. Not on cruising. I want to talk to you about the European debt market too. The German 10-year yield getting very close to zero, within 5 basis points right now. You say, I believe, the Treasury market will underperform what's happening in Europe, in Germany specifically. Why, Subadra?
So that was our call in our year ahead outlook. We thought that the treasuries will underperform as yields rise relative to bonds. It's mostly because of the differential, if you will, in the policy front. I mean, the ECB is going to remain very cautious. There's a few elections coming up in Italy and France, and generally speaking, what they're going to be focused on in the first quarter is shifting from the pandemic purchase program, the PEPP, to the APP. So really their focus is still going to be on keeping policy accommodative in the first quarter. You're seeing the exact opposite in the US. If anything, the Fed is very, very focused on trying to remove accommodation gradually by raising rates and potentially balance sheet runoff. So in this sort of context, it makes sense that yields will rise and treasuries will underperform bonds in a sell-off.
Troy Gayeski, do you agree?
Yeah, I mean, look, it's the same old story with Europe, right? We have much higher terminal growth rates, much higher terminal neutral rates. The ECB's always doing QE forever. And given how much further along we are in the recovery cycle, based on every metric, right? Whether you look at inflation, whether you look at the labor market, treasuries and U.S. Fixed income of high grade should underperform Europe for sure.
Jim, Caron, the ECB has a challenge that the Fed doesn't have. It's Italy. With the Federal Reserve, you look across one market, one treasury market with one set of characteristics. For the ECB, it's several with very different characteristics. I referred to the German bond market as a hyper-sovereign a little bit earlier this week. If you look at Italy, I don't know if it's a credit or a sovereign or a hybrid of the two. Jim, what is it?
Yeah, I would say it's a hybrid of the two. But now, if you look at this a little bit more broadly, Europe has a big inflation problem, and it really stems around energy. So whereas the U.S. market's inflation may be peaking somewhere around the first quarter of this year, inflation in Europe is probably going to continue to march higher due to energy prices. And then look a little outside of Europe. Look at Central Eastern Europe. Look at Poland. Look at Hungary. Look at Czechoslovakia. Effectively, I mean, Czech Republic, let's think about where the where inflation rates are there. They're looking at CPI rates of 6, 7, 8% rates. So essentially, inflation is very, very high there. It's creeping into the Eurozone, but the ECB has a very difficult time hiking interest rates very aggressively because essentially, as you point out, you have a lot of other countries and a lot of other bond markets that may all of a sudden start to act more like a credit than a sovereign, than a risk-free sovereign. So that could create more stress and spread widening, and it could even seep into the credit markets in that space as well. So the ECB has got its work cut out for it this year for sure.
Can they ignore that inflation story, Jim? Because when I look at the US, and I'm pleased you brought up the energy story, you've got headline in the US close to 7, core close to 5. In Europe, you've got headline at 5, but core half of that when you strip out food and energy. Can they take comfort of that 2.5%, 2.6% core rate of the ECB?
Well, see, the problem with Europe is that it's much less of a dynamic, broadly speaking, it's much less of a dynamic economy. They just can't adjust to higher prices. In the U.S., you can get tremendous amounts of wage growth. If the economy turns down, wages can go down. It's hard to bring wages down in Europe just because of the structural nature of their markets and their industries and their business and their politics. So effectively, higher inflation, even if it's 2.6% at the core level, and that doesn't rise up all that much, there's still, the real wages, people are still paying for food and energy. The real wages are still going to be very, very low. Many people are on fixed incomes, especially on pension funds and pension plans. So the real wage growth becomes very, very challenged, and that hurts consumption, and consumption hurts GDP. And once you start to have weakness towards growth, then that creates these credit issues that you're talking about. Yep. So this is a very, very delicate balance for Europe.
They're in a really tough spot, stuck between a beautiful rock and a hard place. The hard place is energy. The beautiful rock, of course, is Italy. When you think about what would lead the Federal Reserve to back off, Gayeski, we touched on this just briefly. The durability of the Fed put with inflation in and around 7, what it would take for the Fed to back away if it's different this time around. Troy, can you talk to me a little bit more about that? The tension that could come from the equity market, the tension that could come from the credit market, and whether the objective actually at this Fed, whether we need to see tighter financial conditions.
Oh, well, we certainly should have some degree of tighter financial conditions now, right? Up until recently, we had the loosest financial conditions in history, yet our nominal GDP is 11% higher than it was pre-pandemic, right? Even before the recent inflation prints, we were obviously trending in that direction. So we definitely should have tighter financial conditions. But the trick, and this is what's so hard in the Fed seat, is doing it in a way that doesn't crater markets, right? So I think the most logical way to think about this year, assuming the Fed gradually hikes and allows the balance sheet to very patiently unwind, is you do have that 2 to 3 turns of multiple compression in equities with 10% earnings growth, and you're somewhere right around down 5, down 4, 3% with the variance of outcomes around that. The problem, of course, is if they do get in a position where, to Jim's point, they really want to get the back end up and they don't want the curve to flatten further, and they start unwinding that balance sheet much more rapidly, then if you get even more multiple turns of compression, again, I would say 5 would be a pretty clear line. And most importantly, the high yield bond and levered loan markets close up, right? Which again, that is really what spooked them in December of 18, right? Yep. We had modest dislocation equities, bounce back, sell off, but it wasn't the end of the world. it was when the high yield bond market froze, and that was the first time it froze. Or the last time it had frozen was in March of 2009, right? And they had to get QE going and all the other programs. So, to me, if you're trying to price in a Fed put, it's obviously deeper now than it was in 18 because there's just so much liquidity out there. And look at where the inflation numbers are. But keep your eye on the credit markets because, as Rick was saying before, Rick Reader, delinquencies and defaults are going to be extremely low because we're in a 5 to 8% nominal GDP environment, a 3 to 4% real GDP environment. So on the fundamental side, you're in good shape. But if you can't finance and roll your debt, it becomes a problem. So, again, I'd say plan on 2 to 3 turns of multiple compression. If we hit 5, that's where the Fed has to rethink things. And if the high yield bond market and levered loan markets can't roll new issuance, that's another point where they're just going to have to freeze balance sheet reduction and then think long and hard about any additional hikes at that point.
Troy Gayeski, Subadra Rajappa, Jim Caron sticking with us. Up next, the week ahead, the final spread. From New York, this is Bloomberg. Live from New York City, a big week ahead. Next week on Wednesday, CPI in America, a sneak peek. Your estimate so far has a 7 handle. With us for the rapid fire round, Subadra Rajappa, Jim Caron, Troy Gayeski. Let's get straight to it, guys. Inflation next week, 5, 6 or 7 handle, or you could just pick a number, any number. Subadra.
7 handle for headline.
Jim.
I'm going to go with 6 handle.
Troy.
High 6, low 7 handle.
How many hikes this year? 1, 2, 3 or 4? Subadra.
3.
Troy.
Going 4.
Jim.
3.
Final one. Let's squeeze this in. Bond yields on 10s. 1, 2 or 3 handle to end the year. 1, 2 or 3. Jim.
2.
Subadra.
2.
Troy.
That one's easy, too.
Come on, guys. That's so boring. I enjoyed this.
Troy, it's a boring business. Come on.
Jim, thank you. From New York, this was Bloomberg Real Yield. This is Bloomberg TV.